Hey there, everyone. I'm Stacy Scott. Good afternoon. I'm the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today's webinar. Thank you so much for joining us today. We always appreciate you taking time out of your day to check in with us and enjoy our monthly Lunch and Learn. As you know, we have had a very eventful couple of weeks, and Graham is going to use our time together today to talk about the current market events, including market volatility and potential next steps. As always, there's going to be a Q&A session at the end of today's discussion. And if you find that you have any questions throughout today's webinar, please enter those into the Q&A section of the chat box, and I'll make sure that Graham sees those and addresses your questions at the end of the session. And as a quick reminder, Graham's calendar will be popping up from time to time. And if you would like to schedule a time to meet with him, just click on the day and time that works best for you, and we'll get that on the calendar. And with all of that buttoned up, I'm going to go ahead and turn it over to Graham. So take it away.
Hey, thank you, Stacy. And really thank you to all of our attendees on the call. I know many clients are on the call, and hopefully some friends and families and just individuals are interested on hopefully getting great information to just better inform ourselves on what's going on with the markets. And as Stacy already alluded to, it certainly has been an eventful couple of weeks. Hey, listen, this whole drama, not just with Ukraine and Russia, it's really been a revaluation in the markets since November, and arguably even a bit before that, where you've had this struggle with growth and value. And I'll add to that a bit more. Don't mind the sirens going off in the background. This is Marietta testing their, I think, their tornado warning system. But there's no tornado today. We're just
Hope not.
Let's be talking about the market. So that was pretty timely. But let's go ahead and jump in. So kind of 4 core points I'm going to be talking about is where we are and where we are now, and then where were we, okay? So I'm going to start off there. But looking at 3 primary areas, the Fed and how they are addressing inflation, how it could affect us, the market, so on and so forth, geopolitical events that I know everyone is aware of, Russia, Ukraine, and then market and corporate earnings. And then some things to expect from a positive or a negative standpoint, because you got to address both sides to be fair and balanced. So kind of jumping in, let's look at kind of where we were, where we are, right? Let's you know, I started this out back in 2020, starting out in February. Think about it, the markets. When I say the markets, I'm going to include generally the S&P, the NASDAQ, the Russell, the Dow Jones Industrials, maybe the Russell 2000. You know, general markets, right? Small cap to large cap, so widely followed indices like the NASDAQ, S&P, and Dow. Listen, they were pretty much at near all-time highs at that particular time. And I'm talking within a percentage point or at highs. Gross domestic product, within I think I'm probably a percent accurate with these numbers. So we have gross domestic product at about 2.4%. And think about gross domestic product as the growth of the U.S. economy. We had the unemployment rate at about 3.5%. Now, keep in mind, 3.5% is basically zero. It'll never show up as zero. But that's pretty much anyone that wanted a job had a job, right? We had the inflation was about 2.2%. But keep in mind over the last 15 years, and I know we alluded on another call, or at least we commented, the last 15 years, inflation has averaged about 1.9%. But inflation, say somewhere around 2.2, 2.4% at the time. And we were teetering on, and I did make a comment, I wouldn't be surprised that we drift into a light recession. Now, keep in mind, a recession is a slowing of the gross domestic product for a couple quarters, let's say below 2%. It is not a recession or a financial collapse in the monetary system. And the reason why I made that that statement is because a lot of fear naturally just goes to what happened in 2008 and 9. That was a collapse of the financial system back in 29. That's not what we're talking about when we're talking about recessions. It's slowing growth under a certain level for a certain period of time. If we think about post-pandemic, and I'm saying post-pandemic, we've moved from a pandemic to an epidemic. I think the State of the Union last night, I don't know if there was anyone there wearing masks at that particular time. So the mask mandates are coming off. Doesn't mean people aren't still getting sick, and we're still dealing with this epidemic of COVID. But obviously, it's not at the height of what it was. Now, listen, the markets are down, who knows, any day. I threw out 10 to 20%. I thought that's a pretty broad range because the markets are up 1%, 2% at any given day. Heck, a week ago when I was out of town on winter break with my son, on that Thursday and then rolled into Friday, we had a volatility in the market of 5+%, astronomical volatility in an intraday movement in the indices. But yeah, the markets are off, let's say somewhere between 10 and 20%. There's whole sides of the market, that growth at any price. There's highly speculative areas that we focused on during the shutdown and the pandemic. Some of these stocks are down 50 and 70%. All right. Then we have gross domestic product. Gross domestic product, remember pre 2.4, it's now 7%. 3 times higher, so huge GDP. Then we had unemployment rate at about 3.9%, pretty close to what it was in pre-pandemic level. Basically zero. You want a job, you got it. You can't swing what I say a dead cat and not hit a sign or a help wanted sign out there. If you want a job, there's one available, right? We have inflation at about 7.5%. Now that's high, right? And that's another thing that's really spooking markets. How do we bring that down? Remember, pre-pandemic is about 2.2%. And then no recession in sight. That could be a little bit strong. I think, there is a very slight chance, but I don't think it's high on the list that we're expecting a recession. And if we did, it might be a light one over the next couple of years, but not necessarily something I'm planning for today. It doesn't have to be deep or protracted recession that I think many of us go back to because it's still fresh on our minds, 2008-9. Right. If we kind of jump in and hitting the kind of core topics that I wanted to cover today, the Fed, what are they going to do? How are they going to combat rising inflation? Now, if you're on the previous calls, I'm going to maybe challenge your thought process a little bit. Or if you haven't, I might challenge your thought process. Think about it's with the Fed. The Fed's mandate is to keep constructive growth, and I'm being real general here, growth, but not too high and not too low, right? So they want to keep inflation somewhere around the 2% range, right? Well, we're at 7.5%. Over the last 15 years, we've averaged about 1.9. We're right before that, we're about 2.2. So we're hitting their mandate pretty right on target. Now, I think that mandate probably needs to go up a little bit going forward. I don't know if Chairman Powell is going to listen to my opinion, but it probably does. I don't think a realistic 2% growth is strong enough for the United States or inflation rate, because not necessarily inflation is bad. Think about rising inflation, right? Or rising rates is what the real concern is. Them raising rates, increasing the cost of borrowing to lower demand, right? They're doing that for a vote of confidence. Listen, you don't raise rates outside of certain other, economic times, but we're just focusing on our situation right now. You don't raise interest rates, when the markets are challenged, when the economies are challenged. It's a vote of confidence. You're raising rates to hopefully lower demand a bit, that animal spirits, maybe increase borrowing cost a bit, to hopefully slow the economy down. Back in the 80s, as perspective, the Volcker era of the Fed, he was the chairman of the Federal Reserve at this time. It's Chairman Powell now. I think interest rates were raised up to 14%. We had inflation at 20%. So really different times. but they do have some rhythm or rhyme to them that I think the market's concerned about, and rightfully so, because when interest rates rise, what it really, or let's say interest rates rise, and inflation being high, that can negatively affect earnings that have growth or expected earnings well into the future, right? But maybe not so much on more conservative companies that are making money today. So as you've heard us talk about, there's that struggle between growth and value. We tend to say, hey, listen, let's buy good quality companies, growth at a reasonable price. They got earnings today. The valuations are reasonable. The margins are strong. They have pricing power. That's where I'm going at with that. They have great cash flow, great product, hopefully a little bit lower competition. That sets you up for very strong companies to weather through this rising rate or high inflationary environment, where the high growth at any price doesn't mean they're not good companies or a good product. Their valuations just can't be justified. And as interest rates rise, that can affect their earnings, which are so projected to be positive so far down the road, 5, 10 years. It's really a struggle right now for the market to wrap their arms around that type of speculation. So that's why we're seeing that side of the market, if you might, down 50, 70%. If we look at geopolitical events, I mean, obviously, it's a horrible situation with what's going on in Ukraine. This isn't obviously the first event. It will not be the last. But the expectation is, what will it do with growth, right? And I'll get to that in a minute. Listen, we got growth domestic product of about 7%, right? That's high. So we can afford that to come down. But is it going to have the global market slow quicker, faster than expected? Which means you're going to see earnings per share come down for companies. You have earnings per share come down for companies because demand or people buying products, corporate to corporate or personal to corporate, is going to come down. That's going to lower earnings. Earnings generally follow stock prices, hence the concern, hence the stocks pulling back. Just want to kind of give you an idea how that works. But also commodity inflation. Listen, commodities hit us, all consumers, right in the pocket. You know, you're talking about commodity. Russia, I think, supplies 10% of oil internationally. I think it supplies to Europe roughly around 40%. That might be on the gas side. The same. It's about 50% for Germany. So when you think about international markets, they're going to be very affected more from commodity shocks, interest rate shocks, because they have more material, commodity, and financial exposure internationally, where we're less driven on that in the United States. And that's represented in our indices compared to their indexes like the S&P, so on and so forth. Again, I know some of this stuff I'm covering pretty quick and a little higher level. Reach out to me. I'm happy to kind of bring it down a little bit more, but I want to make sure we cover everything. When we think about market performance, listen, the drawdown of the sell-off is roughly been on average since World War II, and I think we've had a couple skirmishes since then, about 5.7%. Listen, the markets are down, I don't know, today, 10 to 20% is what I threw out, maybe a little less, maybe a little bit more, depending on which index, which asset class you're looking at, what side of the market you're looking at. But the worst wars in modern history, the markets were up a combined 115%. So we might be thinking about the short-term shocks, but then the markets stabilize, are able to digest, and then move off of that. Doesn't take away the horrible nature of these skirmishes and what's going on, but it's just kind of what's happened in the past. Again, no guarantee for the future, but I think the past does have some rhythm to it. It does rhyme in a way. If we look at the U.S. involvement in Vietnam, from 65 to 73, the S&P gained. We're pulling some of these back. You need the PowerPoint on our website. So yeah, it doesn't mean we're not going to have shocks. It doesn't mean we're not going to have pullbacks. But months after 6 months, 12 months, we're generally seeing markets getting back to their rhythm, as long as it doesn't draw us into a deep recession, which we don't think that's going to be the situation. If we think about the markets and corporate earnings, This is where I said we adjusted where the Dow and the S&P, the Dow's down about 6.75%. The S&P is off about 8%. The NASDAQ's off 12.5%. And again, take these numbers with a little bit of grain of salt because I don't know where the market's going to be today, But look at the chart and just stand back a little bit and say, hey, listen, this chart is from, Stacey, how long is this chart? 1870?
Yes, and
right.
And to 2020, and just beyond.
You're right, and just beyond. Look at the general trend of this chart. Now, these little squiggly drops and peaks in this chart doesn't mean that we don't have volatility, and those are periods of volatility on the upside or downside. But I think this is something that we want to be mindful of when we're thinking about investing, not just in the long term, but also intermediate and short term, is that the general trend is up, right? We get it. But also you have periods where the market just kind of creates more rallies, goes up, and then it plateaus for a while, right? And then it usually has a shock, and then it plateaus, it digests that rally went through, it sells off because of the shock of something. Maybe it's valuations, maybe it's war to justify selling for valuations, something, right? And then it goes through a period of where it levels out and digests, it kind of churns around, and then it goes up again, and it creates a very consistent pattern. And again, no guarantee of the future, but I'm a big believer in history. I'm a big believer that it leaves clues. It has some rhythm to it, right? So that doesn't mean when we look at these plateau periods, if you look at it, I mean, they're years. They can be a year, 5 years, 10 years, 20 years. But it doesn't mean that we don't still come off of that base and move up. All right. So I think it was a pretty interesting chart when my team was putting this together to show, listen, the general trend's up, but we do have periods of volatility. Heck, as I mentioned before, and I feel like I might get some negative press on this, we might have a year that we just don't go up. What if we sold off all we're going to sell off, and then we could just come back to where we started the year at? I mean, is that the worst thing? Ideally, I want the markets consistently go up, but we just might have to settle into it. Just might not be as good as it was the last 3 years, right? So if we look at now kind of 4 primary problems or challenges that I see for the market, naturally high inflation. Naturally high inflation is going to erode the purchasing power of corporations, consumers, which means they're going to have to use more of the profits and revenues, the income they're bringing home to buy goods and services, which is going to take away from something else. And the Fed's involvement with that, meaning Fed tightening, how quick, how fast could put angst in the market, maybe, create some additional cracks or concerns, because the longer that inflation stays high, might be longer that the Fed has to have a hawkish policy. You hear that dovish, hawkish comment. Hawkish, they're trying to be more attentive to getting inflation down. More dovish, they might want it to maybe allow a little bit higher inflation. They're tending to be a little more hawkish right now. We'll have to see. They haven't even raised rates yet, but they're already signaling to the market that they will. Now it's going to come down to how quick, how fast, and how will the economy adjust to that. Slowing growth, yeah, I mean, we're looking at comparables over the last couple of years. They're going to be tough. I mean, listen, when we're stuck in our homes and we don't go to work, but we're still getting money hitting the bank accounts and the mailboxes, listen, we're spending, right? We haven't been going on vacation, so we're taking the money there and we're spending it over here, maybe on home improvements, maybe on a new home, maybe on a car. Yeah, spending's still there. We got strong employment numbers, which means people have jobs. We got strong wage pressures, which is higher inflation, which is less sticky, which means it'll probably not come down as much. But people who are looking for jobs and whatnot are in a better bargaining situation and probably obtaining a bit higher wages, which is more money to spend, so on and so forth. But the year-over-year comparison, corporate earnings, has come down a little bit, and that could put some added pressure on the market, trying to figure out that, hey, listen, if earnings are going to grow, is that going to meet the market? So if we look at history, and we look at the S&P real EPS growth, they're expected right now to be somewhere around 10%. But if we look over the last 150 years, and we pulled this Schiller, earnings growth is averaged about 3.5%. So we're still in a very, very, very strong growth period. All right. And we still have really, really strong consumer demand in the market. So I think that's a really good thing. We have low but rising interest rates. Rarely have we gone into a protracted bear market, meaning 10% drop in the indices for a protracted period of time outside a couple of days, weeks, months, quarters, if you might, when we have such low interest rates. And then we have extremely bearish sentiment out there. So think about that. It's kind of odd to think about it, but if you think about extremely bearish sentiment, you want everyone to be throwing the baby out with the bathwater, right? You don't want any optimism in the market, and we are extreme lows. The bearish sentiment is 54%, right? The average is 40, so we're high. The bullish sentiment average is 38, we're at 23. So you got to think, the bears are winning right now with that bearish sentiment, which for me, were of a contrarian or a value type approach, I'm going to say, okay, if people are very, very, very bearish, we might not necessarily be setting lows in the market. Well, we could be closer than not. And then I would say the pandemic relief. We're moving from a pandemic to an epidemic. I want to get out and about and travel. I don't know what client I'm talking to or how many clients I'm talking to right now that are saying, hey, listen, I'm planning my cruise, I'm planning my trip. Maybe you are too. So I think that buoys or supports earnings, spending patterns that can help support this market going forward. So amongst the negatives that we had on the previous slide, I think we also have to embrace some positives here and keep in mind that you got a plan, you got to work the plan. And I know I say this over and over, I sound like a broken record. So you work the plan, that you planned ahead, and you don't make big changes unless something fundamental has changed in your life to make that plan. So the one last thing I'll leave, and I know I've commented before, I like to use the fog of war, right? So think about your retirement, your planning process as a war. It's something long, right? But within that war, your life, your retirement, your plan, if you might, you have battles, right? Battles might be market volatility. It might be a child that needs to go to college or they need a little extra assistance. It might be in health issues. So you have these little battles. But among your battles, you don't want to change your whole plan of war. So when those bullets are flying, the bombs are dropping, that's not when we advise making big adjustments to your long-term plan. Always tweaks can be considered, but not big adjustments. And if you plan ahead, you'll know how to manage through some of these more trying times. Stacy, I think that kind of wraps up my part of it. We want to open this up to a little question and answer.
Absolutely. We have gotten a few questions in, and I've been making a note of that. The first one is, how would the markets be affected if this Russia-Ukraine situation is prolonged?
Well, keep in mind that's going to be a commodity shocks. That's going to be commodity inflation. That's going to be displacement of Ukraine and the population and what relief will have to go. I think it would be less of a positive and a protracted environment for a commodity standpoint that will end up hurting every consumer, certainly Europe in that area. So I think a protracted would not be great, but keep in mind, it wouldn't be great for Ukraine or Russia either. And I don't know, and again, I don't have the mind of, but I don't know that Russia can afford to be in another Afghanistan, nor the United States in another Iraq or Afghanistan or Vietnam. So, I mean, just using, previous periods to tell you. So I don't know if we're looking at a protracted, but I don't think it would be a huge positive. I don't know it has to necessarily be a huge negative. We'll just have to see. It wouldn't be great on energy prices, though.
Okay. How will the market react if oil prices continue to rise?
Well, I think it goes back to the previous statement. I think, bear with me a second. I think if oil prices continue to rise, that's going to hurt the pocketbooks of the consumer, not just in Europe, it would probably be more affected, but it would be over here in the United States. I mean, again, Russia distributes 10%, supplies 10% of the world's oil. It supplies a huge amount to Europe, not to mention Germany, in terms of gas and oil. And I think that could continue to be affected. But, it's if we can figure out a workaround, right? If it's not Russia supplying it, we're not buying their goods and services, so on and so forth, then who are we going to get it from? And can we fill that void? And can it be filled in an efficient manner? I think the market's trying to figure that out too.
Okay. Next question. Should I think about changing my investment plan based on markets and the war?
Absolutely not. I just gave him my horrible analogy of the war and the battles and guns flying and smoke flying. Adjustments are always a part of an effective, I think, mindful investment portfolio, not to mention overall financial wealth management plan. But going in and making big adjustments and changes, listen, you shouldn't. If you've done your homework, if you're working with us, I know we've done our homework with you as a partnership. We've planning ahead. We've kind of addressing what if. And if you've done that ahead of time, you shouldn't have to, right? That can be sometimes the biggest mistake that you can make.
Okay. I thought that was going to be your answer based on what you said earlier. How long do you think it will take for interest rates to come back down on average?
Boy, isn't that $1 million question? I don't think as quick as everyone originally thought, right? And I think everyone's kind of getting into that camp. If you're on previous calls, you've been a client of ours, you know that we've said interest rates are going to be sticky. They're going to stay up, meaning stay up higher for longer. Listen, when you're raising people's wages, and all of a sudden, hey, inflation has come down, so supply chain is loosened up, maybe demands come back, I'm going to go ahead and cut all your salaries. I don't think that's going to fly too well, right? No. I know it wouldn't go over too well here. So I think that's right. That's what's called sticky. It's not as transitory. And I think now that you got supply shocks with oil, you still got demand there, you got the war going on, so on and so forth. That just props up inflation, which might be a little stickier for longer, which means you might have a little more Fed activity, which is again causing angst in the market. So I think you're looking at a protracted period of well above average inflation, meaning well above 2% for the foreseeable future. And I'm speaking years. I hope I'm wrong. I hope I am. But I would say you got to think about real returns on your portfolio. You got to think about, fortunately or unfortunately, taking more risk, having a more active approach in your portfolio to beat inflation. Now, I always put it this way. If inflation just comes down to 5%, that's well above the 1.9% 15-year average, right? If it comes down to 4%, same scenario. 3%, same scenario. And think about this. Yeah, money market accounts, CD rates, ultra-conservative bond interest rates will go up, but at the same time, bond prices will continue to struggle in an environment. Doesn't mean you don't own bonds. That's not where I'm going. They're going to struggle. So where I'm going at, you got to think about real returns. If inflation's 3, you got to make more than 3% to have a real return. If inflation is 7.5%, you got to make more than 7.5% to make a real return, right? And it only gets worse if you got to think about taxes because you're taking out of retirement plans. It's income that you're paying income tax on, so on and so forth. So not to beat that one over the head too much, but that is a really big concern, I think, right now for our pre and post retirees in terms of making sure you have a real positive return.
Absolutely. I mean, that's a lot to think about. Talking about these retirees, we actually have our retirement planning today class scheduled beginning next week. So for folks who are at that point in their lives and they're looking at retirement, if you want to learn the A to Z about that, please give us a call, and we have a few spots still available for our Tuesday class and our Saturday class. And also, we weekly have our weekly wrap-ups, and Graham touches on all of the current events that are going on from week to week, so that helps everyone to stay on top of every situation that affects the market. So we would love for you to tune into that as well. Thank you so much for everyone's time today. Thank you for joining us today and every webinar each month. We'll be looking forward to seeing you again at the end of the month for another Lunch and Learn. And as always, with any questions, call Graham or the team. We're happy to help you out. Thank you so much.
Have a great day. Thank you.